All right. Assalamu alaikum rahmatullah, everyone. Good morning. Welcome to our webinar today on the UAE corporate income tax that we will be referring to as corporate tax throughout our presentation. This is Yasser Atiyah, and I will be joined together with the three of my colleagues as we will discuss in details during the agenda. I hope you are all doing well. Thank you very much for joining and attending our webinar today. I can see some people are still logging in, but we are going to start now. So welcome again to this important webinar on the implementation of the corporate income tax in the UAE. Which is, as we all know, is now certain by the issuance of the UAE Corporate Tax Federal Decree Law number 47 during last month, during December of 2022. As I mentioned, I'll be joined together with the three of my colleagues who are going to be taking over the parts of the presentation on UAE corporate income tax. And thank you once again for attending. In terms of housekeeping rules, we hope there is going to be a room for questions and answer at the end or towards the end of the presentation. But please feel free to post your questions during the course of the presentation on the chat box, and we will make sure that we address these questions either at the end of the presentations or individually after the session. Our presentation is going to run for approximately 1 hour until 12 p.m. noon today. We will be circulating the slides, the materials, as well as we will be recording the session today, for which we will later post it in our website and add it to our YouTube channel. So thank you once again very much for attending, and I hope you will enjoy the session and we will find it beneficial. In terms of our objectives at the end of our webinar, I hope today in the corporate tax implementation in the UAE that we will be able to provide you with a good general detailed awareness on the application of the corporate tax, as well as understanding of the implications on the businesses and companies that will help in terms of planning and thinking about the readiness assessment in terms of the implementation of the corporate tax. Moving to the agenda today, as I said, we have, in terms of today's webinar, the content and the agenda. After I'll be going through the overview, introduction, and a bit of the timeline on the corporate tax. We have divided our sections into, or our agenda into 3 sections mainly. As you can see on the screen, arranged or divided in some important topics. We try to cover as much topics as possible within the 1 hour time frame, and it is, as you can see, arranged by the manager section. As you can see on the screen, the content of today's webinar, we have divided into the content into the several topics that will each take approximately 15 to 20 minutes. These sections are covering subjects as per areas of the regulations that we have selected, and we believe they are important to be discussed and presented under each section. Understanding of the corporate tax law in terms of important definitions, as you can see, will be covered by Muhammad Fawzi at the beginning. We will be going through some basic definitions, of course, and on the assumption that some people have no knowledge or experience whatsoever in terms of the corporate tax, whether in UAE or outside. But we will also dive into some more complicated areas, as you will see, in terms of, for example, transfer pricing, withholding tax, free zones areas, and others that we will touch on, and hopefully we'll be able to answer your question. I'm sure you appreciate at this point of time we only have the law has been issued, but there will be executive regulations and a lot of guidance to be issued within the next few months. Hopefully that will answer not only your questions but also ours. In terms of moving on for the introduction and overview before we dig into the details of the subjects, as you are aware, law number 47 of 2022 has been issued or released by the Ministry of Finance on 9th December 2022. So although it was actually released on the 9th of December, but it dates back to October already. And when we look at the timeline for the publication of the different documents, or how we become aware of the corporate tax law in terms of general public, the first formal confirmation that the UAE will implement the corporate income tax came on 31st January of last year, when there was a press release published by the Ministry of Finance. And at the same time, also FAQs was published on the Ministry of Finance website. That was followed by a public consultation document issued by the ministry a few months later on April 2022. This was a public invitation for businesses and regulators to provide comments and observation in regards to the public consultation and in regard to the questions and answer and the definitions that they provided back in January. And as you are aware, the corporate income tax law was published in the sense of being announced by the Ministry of Finance. Although the law itself was published on the official gazette on the 3rd of October of 2022. And by the time it was released, it was actually already in effect, which has passed 15 days from the date it was signed by the president and published on in the gazettes, and the official gazettes of UAE. As at the moment at which we are going to starting to pay UAE corporate income tax, as you are aware, it's effective 1st June 2023 on rolling forward basis, as companies that are calendar year will be start paying or accounting for corporate income tax starting from 1st January 2024. So for calendar years financials, although the law will be effective on 1st June 2023, the law will apply on a calendar year financial, which is most of the maybe taxpayers or companies have in this country is calendar year. So effective 1st January 2024, they will have to start counting in terms of corporate tax. Of course, we will talk about the transitional rules, what businesses will need to consider, and companies before what they will call the closing or the opening balance sheet before they implement the tax, before the implementation date based on the financial year applicable, and what needs to be considered in that terms. For companies with year end, for example, 31st May, it will become effective from 1st June 2023. As you can see, the 31st May financial year will really hit effective from the first day the law become effective. versus companies, for example, with year-end 30th April, that will take them to become effective on 1st May 2024. So I think for these entities with the year-end 30th April, they would probably have the most extended period before they become subject to the corporate tax in the UAE. Now, as we going to be digging into the details of the corporate tax law contents and subjects, as we mentioned on the agenda, when we look at the law itself, that there is really a great deal of aspects in terms of implementations of the corporate income tax. As I mentioned, we only have currently as you can see, the announcement by the Ministry of Finance, the FAQs that was published, and then the law itself. But in terms of implementation of the law itself, I can't see, or most likely it will be delegated legislations in terms of legislation which is yet to be issued. That legislation will come most likely from different levels, whether being cabinet level, minister levels, or tax authority level, as will be managed, of course, as we all know, by the Federal Tax Authority. So we can expect in the next few months a multiple layer of legislations, cabinet decisions, announcement. Maybe, as you are aware, the FTA is already performing or conducting some awareness sessions, but there will be a lot of guidance in terms of different subjects. The today presentation is really just to go through the basic general topics without digging into too deep into the subjects. That will be the different sessions on certain complicated areas, for examples such as the transfer pricing and arm's length basis transactions between related parties. So do please stay tuned and stay connected with us throughout through our presentation and the upcoming sessions and updates that we will try to post and send as soon as we get any update. Now we'll give a space to my colleague, Mohammed Fauzi, who will be walking you through his section of the topics. To you, Mohammed. Thank you, and see you guys later.
Good morning, everybody, and thank you for attending our webinar today. This is Mohammed Fauzi. I'm Assurance and Tax Manager at XB4. Today, I'm here to talk to you about the UAE corporate tax. I'll be covering the first section as mentioned by Mr. Yasser. So I'll get straight to the subject. So let's get started. We'll start with the definition, rate, and the scope of corporate tax. Before we dive into the corporate tax, just first we need to know what is corporate tax. Corporate tax, it's a form of direct tax that imposed on the net income of companies from their business. It's also commonly known as corporate income tax or business profit tax. Form of direct tax. Direct taxes are the taxes that paid directly to the government, which imposed on the net income, like corporate tax or capital gains taxes. There are also indirect taxes, which are indirectly paid to the government through an intermediary. It's charged on the sale of goods and services, like the value-added tax and sales tax. Corporate income tax shall be imposed on the taxable income for the taxpayer at the rate determined by the authority. So what are the corporate tax rates? When it comes to tax rates, the UAE corporate tax law differentiated between the taxable person and qualifying free zone person. For taxable person, the tax rate will be 0% for taxable income up to 375,000, and 9% up for the taxable income above 375,000. For qualifying free zone person, it will be 0% for the qualifying income and 9% for the taxable income that is not a qualifying income. Qualifying income, it's the income derived by the qualifying free zone person. And the qualifying free zone person himself is the person that, or a free zone person that meets certain conditions specified by the authority. And we will come in more details about the free zone persons and the qualifying income in the next sections. There will be also a different tax rate, still not yet specified by the authority for large multinational entities that meet a specific criteria. Continuing to a definition rate and the scope of corporate tax. Corporate tax shall be imposed on taxable persons who are either resident person and non-resident person. Non-resident person and non-resident person. Who is the resident person? Resident persons are companies and legal entities that are either incorporated in the UAE or effectively managed and controlled in the UAE. Also, it includes the natural person in the UAE. For non-resident persons, who are non-resident persons? They are any person other than the resident persons, and also it includes foreign legal entities with a permanent establishment in the UAE. So what will be the tax base for resident person? For resident persons, the income derived from the within or outside the UAE are taxed. So in brief, both of domestic and foreign source of income are taxed. What will be the tax base for non-resident persons? Only income generated from the source within the UAE is taxed. Moving ahead to the next, tax registration and deregistration. Similar to the current taxes in the UAE, tax registration is required for UAE corporate tax. But who can register for corporate income tax? Any taxable person or the tax registration for UAE corporate tax is mandatory for any taxable person to register for the UAE corporate tax by submitting the request register to the authority in order to obtain its tax registration number. So what about the exempted persons? Exempted persons also are required to submit tax registration to the authority in order to obtain the UAE corporate tax exemption. Tax deregistration. When can a taxable person deregister from corporate tax? It would be at the time of cessation of its businesses, whether by dissolution, liquidation, or otherwise. But before the deregistration, and similar to the current taxes in the UAE, any pending or the taxpayer should file any pending tax returns in respect of the UAE corporate tax returns and pay any due administrative penalties or any due corporate tax penalties. Also, the effective date of the deregistration shall be the date of cessation of the business or any other date that will be determined by the authority. Tax returns. The UAE corporate tax return should be filed, but when to file a tax return? For any taxable person, must file the tax return within 9 months from the end of the relevant tax period. And we believe that this period, it's more than enough for businesses to prepare their tax returns. As we can see in other states, it's between, or the range is 3 months only. So what about in case of no income or dormant companies? Also, they are still to submit the tax return to the authority. Who is responsible for submitting or filing the tax return among groups? When it comes to the unincorporated partnerships, the authorized person is required to file the declaration on behalf of the other partners. And when it comes to the tax groups, the parent company or the representative member is the responsible one to file the tax return to the authority on behalf of the other tax group members. There are certain certain exempted person are required to file the declaration to the authorities. It's still not specified by the UAE corporate tax law. Components of the UAE corporate tax return. As we said, after the end of the tax period, the taxpayers are required to submit or to file the tax return to the authority within 9 months. But what are the components of the tax return? The tax return shall include the following: the tax period and name, address, and TRN tax registration number, the date of submission of the tax return, the accounting basis used in the financial statements, whether it's the accrual or the cash basis, the amount of tax loss relief claimed. Will come in details and more details about the tax loss relief in the next sections. The tax return will also include the tax loss relief claimed during the tax period. It also include the taxable income for the tax period, which is subject to the 9%, the available tax credit claimed, the amount of tax loss transferred, if applicable, the tax loss transferred to the subsequent tax periods, and the corporate tax payable for the period which are required to be settled to the authority. Financial statements. Are the financial statements mandatory for corporate tax purposes? Actually, the authority may request certain categories to prepare and maintain the audited financial statements. So what about the other taxable persons? Also, they may be requested by the authority to submit their financial statements, which used to determine the taxable income. Tax period of the corporate tax. What will be the corporate tax period? It will be a period of 12 month financial year for billing the tax return. Also, the end and the start of the tax period could be changed on a later stage by the taxpayers. Record keeping of the corporate tax. For how long the taxpayer needs to keep his records. The taxpayer should keep the records for and all the supporting and documentation records for a period of 7 years from the end of the relevant tax period. What about the exempted person? Are they obligated to to keep the records for the EU corporate tax? Yes, it's mandatory for the taxable persons as well as the exempted persons. Transfer pricing documentation. For the transfer pricing, it's a significant subject in the EU corporate tax. We will come in more details about the subject in the next slide. But just here, we will talk about the documentation of the transfer pricing. That it could be the case that the FTA requests the taxable person to file a disclosure containing all the information regarding the transactions and arrangements made with the related parties and connected person. So, so the authority may request these information just to verify and check whether the transactions and the arrangements between related party and the connected person meet the requirements of tax of transfer pricing and arm's length nature or standard. Calculating the taxable income. How to calculate the taxable income? Generally, the corporate tax is imposed on taxable person earning taxable income during the taxable period. But what is taxable income? It's the income subject to corporate tax. How to determine it? A taxable income determination should be done based on reliable and sufficient financial statements, wherein the starting point will be the accounting profit of the tax period, which would subject to certain adjustments. So this accounting profit will be subject to the following adjustments. Number one is non-deductible expenditures. Number two is tax loss relief. Number three is transfer pricing and exempted income. We'll come in details for everyone, and however, we will talk in more details in the next section about tax loss relief, exemption, and transfer pricing in the next sections. We'll start with the non-deductible expenditures. It's the expenditures that incurred during the tax period and are not allowed to be deducted from the accounting profit. That's why there would be an adjustment for these expenditures if it's already deducted before by the taxpayer. It includes unrealized gains or loss on capital items, any expenditure not incurred for the business similar to the current taxes, expenditure for earning exempted income, bribes and other illicit payments, fines and penalties, 50% of the entertainment expenditure. Entertainment expenses are the expenses incurred for the purpose of receiving and entertaining the taxpayers, customers, suppliers, shareholders, or any other business partners. It could include, but not limited to, meals, accommodation, transportation, admission fees. So all of these only will be deductible up to 50%. So not the full 100% will be deductible from the accounting profit. Loss is not connected with the business. Donations to non-qualifying public benefit entity. However, if there are donations to qualifying public benefit entity, it would be deductible. And we will come in more details about the qualifying public benefit entity in the section when we will be talking about the exemption under the UAE corporate tax. Dividend or distribution of profit in any other form. Tax on foreign sourced income and the corporate tax, recoverable VAT, all of these are not deductible under the UAE corporate tax. And finally, the non-operational interest expense, interest in excess of 30%. It's up to 30% percentage, it will be deductible. The above will not be deductible. It will be carried forward to the next 10 tax periods, and we will discuss in more details about the interest expenditure in the next slides. Still, we are talking about the taxable income, but before we come to this, we will move to the next one. We discussed about the non-deductible expenditure. We will discuss about the tax loss relief. However, we will discuss in more details about it in the next section, but just will give a brief about it. Tax loss relief can be offset against the taxable income of the subsequent tax periods to arrive to the taxable income. The amount of tax loss that used to reduce the taxable income of the subsequent tax period cannot exceed 75% of the taxable income. And the remaining tax loss, in case if there are, it shall be carried forward to the next or the subsequent tax period to be deducted, also with the same limit up to 75%. The third adjustment item under the calculating the taxable income is transfer pricing. As we said, we will come in more details about it, but transfer pricing could be an adjustment item under when it comes to calculating the taxable income. In general, while determining the taxable income, transactions and arrangements between the or with the related parties and the connected person must meet the requirements of transfer pricing and must meet the arm's length standard. So what in case of it doesn't meet the arm's length standard, the FTA would check to determine whether it meets or no. In case of no, the FTA would make an adjustment to both parties, which would be the adjustment items. So transfer pricing could be an adjustment items while we are calculating the taxable income. The last one, exempted income. However, we also will discuss in more details about the exemption in the next section, but there are certain exempt income which should not be taken into consideration while we are calculating the taxable income. It includes dividends or other profit distribution either made by a UAE tax resident or any foreign juridical person. Other specified income from participating interest, and we will come in more details about participations in the next sections. Income from foreign permanent establishment, income arising out of intra-group transfers, and non-resident income from operating aircrafts or ships in the international transportation. Also, we'll come in everyone in more details while we'll be talking about the non-resident person operating the aircraft or international transportation and the permanent establishment participation. All of this will be under the exemption section. Realization basis. For a taxable person who prepare the financial statements on accrual basis may be subject to election to use the realization basis when accounting for gain or losses on the following accounts: assets and liabilities subject to fair value and impairment, and assets and liabilities held on capital account at the end of the tax period. For assets held on capital accounts, these are the non-current assets which are not for trade and eligible for depreciation, like the property, plant, equipment, investment property, intangible assets, and any other non-current assets. Liabilities held on capital account are also the non-current liabilities that are incurred, which do not give rise to deductible expenditure and other non-current liabilities. Moving ahead to deductions under the UAE corporate tax, we already discussed about the non-deductible expenditures. Here we'll discuss about the deductible expenditures, or what are the deductions under the UAE corporate tax. Deductible expenditures similar to the current taxes in the UAE, or especially the value-added tax. Any business expense incurred exclusively for the business purpose are deductible. So what if it's for more than one purpose? It must be apportioned if it's identifiable. Interest expense deductions. We discussed it before in brief about the interest expense deductions, but when it comes to the interest expenditures, there are two rules, which are general interest deduction limitation rules and general specific interest deduction limitation rule. Uh, Generally, interest expenditures uh, are deductible in the tax period which is incurred. And also it will be deductible up to 30% of the accounting profit. This would be before interest, taxes, depreciation, and amortization, which we call EBITDA, and this for sure excluding any exempted income. To be entitled for the 30% claim or deduction, the interest expenditure for a tax period must exceed a threshold. Still, this threshold not yet specified by the authority, and the remaining 70% of the interest expenditures shall be carried forward to the next or to be deducted in the next 10 tax periods. The second rule is the specific interest deduction limitation, and this is mainly or based on the interest expenditures with the related parties. So the interest expenditures from a loan for related parties or from a related parties for a dividends redemptions cannot be deducted unless the taxpayer can prove that this loan was taken for no tax advantage. But when to say that there is no a tax advantage or corporate tax advantage? In case of the related party is taxed at 9% or more on the interest under corporate tax or similar tax. Settlement of the corporate tax. How to settle the due corporate tax to the authority? The corporate tax law specified four methods of settlement, which are as following. The due corporate tax should be first settled against any available withholding tax credit. If there is no, it should be settled against any available foreign tax credit. Also, it should be settled against any credit or other form of relief specified in any other decisions. If still there are due tax, then the remaining balance or due corporate tax should be settled within 9 months from the end of the tax period. And for sure, all the amount should be quantified in the UAE dirham. This is the end of my section. I'll give a space to my colleague Doheb, who will take it forward for the next section. Thank you.
Hi everyone, good morning, and I hope you all are fine. As introduced by Mr. Yasser, this is Zohaib, Manager, uh, Audit and Taxation at XP4. We will be discussing about some important definitions and concepts for the corporate income tax in the UAE. Let's start with the exempt person. Who are exempted from the corporate income tax in the UAE? We can discuss some of the persons like government entities and government control entities, like they are and that are performing mandated services and activities are exempt from corporate tax. Other persons who are doing extractive and non-extractive natural resource businesses are also exempt for the corporate income tax. So we can discuss what is extractive business. The business of exploring, extracting, removing, or otherwise producing and exploiting the natural resource of the state. are extractive businesses. And what are the non-extractive businesses? The businesses of separating, treating, refining, processing, storing, transporting, or distributing the natural resource of the business are the non-extractive businesses. And we can also define natural resources. What are the natural resources of the state? The natural resources include water, oil, gas, coal, naturally formed minerals, and other non-renewable, non-living natural resources that may be extracted from the state's territory. The qualifying public benefit entity is also exempt from the corporate tax. What is qualifying public benefit entity? Number one, the established and operated for religious, charitable, scientific, artistic, cultural, athletic, educational, healthcare, environmental, humanitarian, animal protection, or other similar purposes, and the entity which operated exclusively for the promotion of social welfare or public benefit. The qualifying investment fund is also exempt from the corporate tax. Qualifying investment fund, an entity whose principal activity is the issuing of investment interests to raise funds or pool investor funds or establish a joint investment fund with the aim of enabling the holder of such an investment interest to benefit from the profits or gains from the entity's acquisition, holding, management of disposal of investments. Wholly owned and controlled UAE subsidiaries of a government entity are also exempt for the corporate income tax. Moving next, we can discuss about the state source income. So what is state source income? The income accruing in or derived from the state is the state source income. Derived from a resident person or from a non-resident person wherein the income is from permanent establishment of that non-resident person in the state. Accrued in or derived from the activities performed, assets located, capital invested, rights used, or services performed or benefited from in the state. Now we can discuss some examples of state source income like the sale of goods in the state, provision of services that are rendered or utilized or benefited from the state, contract insofar as it has been wholly or partly performed or benefited from the state, the income from movable or immovable property in the state, disposal of shares or capital of a resident person, use or right to use in the state or the grant of permission to use in the state, any intellectual or intangible property. Interest on the loan that is secured by movable or immovable property located in the state, or interest on the loan wherein the borrower is a resident person or a government entity. Insurance or reinsurance premiums if the insured asset is in the state. The insured person is a resident of the state, or the insured activity is conducted in the state. Here are some other important concepts like permanent establishment. What is permanent establishment? A place of business or other form of presence in the state of a non-resident person. So we can say a non-resident person has a permanent establishment. So when we can say that the non-resident person has a permanent establishment in the state, where it has a fixed place in the state through which the business is conducted, or where an agent has and habitually exercises an authority to conduct a business in the state on behalf of the non-resident person. A fixed place in the state have many examples, but as an example, we can say a place of management, branch, an office, a factory, a workshop, land, buildings, and other real property, a mine, an oil or gas well, a quarry, or any other place of extraction of natural resources, an installation or structure for the exploration of renewable or non-renewable natural resources, a building site, a construction project, or place of assembly or installation. Fixed or permanent place in the state shall not be considered a permanent establishment if it has been used for example, uh, storing, displaying, or delivering of goods or merchandise belonging to that person, keeping a stock of goods or merchandise, purchasing goods or merchandise, or collecting the information from the non-resident person, or conducting any other activity of a preparatory or auxiliary nature for the non-resident person. Now, the question is, who is an agent? A person shall be considered as an agent if a person habitually concludes contracts on behalf of the non-resident person or negotiates contracts that are concluded by the non-resident person without the need for material modification by the non-resident person. Moving on, here we can have a brief about partners in an unincorporated partnership. What is uh, unincorporated partnership? A relationship based by a contract between two persons or more, such as a partnership or trust or any other similar association of persons in accordance with the applicable legislation of the state. In general, an unincorporated partnership shall not be considered a taxable person in its own right unless the partners in the unincorporated partnership make an application to the authority to be treated as a taxable person. Persons conducting business as an unincorporated partnership shall be treated as an individual taxable person. Taxable income of a partner. What is the taxable income for a partner? The expenditure incurred directly by the partner in conducting the business of the unincorporated partnership, or the interest expenditure incurred by the partner in relation to the contributions made to the capital account of the unincorporated partnership. How the interest paid to a partner shall be treated. How we can treat it. So the interest paid to a partner on their capital account shall be treated as an income to the partner and is therefore not a deductible expenditure for calculating the taxable income of the partner in the unincorporated partnerships. Moving on, we can discuss family foundation. What is family foundation? Any foundation, trust, or similar entity that established for the benefit of identifiable natural persons or for the benefit of a public benefit entity or both, and its principal activity is to receive, hold, invest, disburse, or otherwise manage assets or funds associated with the savings or investment. A family foundation can make an application to the authority to be treated as an unincorporated partnership if the conditions have been met, what I have described. So, what will be the effective date after the application made to the authority for this family foundation? It will be treated as an unincorporated partnership effective from the commencement of the tax period in which the application is made or from the commencement of a future tax period or any other date determined by the authority. Free zone person. What is a free zone person? A free zone person is a juridical person incorporated, established, or registered in a free zone, including a branch of a non-resident uh, foreign person registered in a free zone. In simple words, we can say a free zone person is a person registered in a free zone. And what is a qualifying free zone person? A free zone person that meets the following conditions. For example, maintain justifiable substance in the state, such as licenses, employees, expenditure, and premises, derives uh, some qualifying income as specified in the cabinet decision, not elected to be subject to corporate tax, complies with the UAE transfer pricing provision, and meet other conditions which may be specified by the minister. If all of the conditions what I have mentioned were met, then a free zone person can now be considered as a qualifying free zone person. Now that we are able to identify how a person can be a qualifying free zone person in case, uh, what if the qualifying free zone person fails to meet the condition? If the qualifying free zone person fails to meet any of the conditions that have been mentioned at any point of the at any point of time during the tax period, it will no longer be a qualifying free zone person from the beginning of the same tax period. Additionally, the minister can provide conditions in which a person can continue be a qualifying free zone person. The income derived by a qualifying free zone person is subject to 0% on qualifying income and 9% on taxable income other than qualifying income. Moving on. A qualifying free zone person might choose or elect to be subject to the UAE corporate tax at normal corporate tax rates, for example, for the purpose of taking advantage of a tax treaties between UAE and a foreign country. The election shall be effective from the beginning of the tax period when the election was made or the beginning of the next tax period. Moving next, we can learn about foreign permanent establishment exemption. The election not to account for other income and associate expenditure of foreign permanent establishment can be done by a resident person when determining for the taxable income. Exemption applied to transactions such as losses incurred in any of the foreign permanent establishment, positive income and associated uh, expenditure in any of the foreign permanent establishment, any foreign tax credit available. The exemption shall apply to all foreign permanent establishments of the resident person that meet the conditions. Now we can discuss the non-resident person operating aircrafts or ships in the international transportation. The non-resident person that perform international transport of passengers, leasing or chartering aircrafts or ships, and leasing of equipment which are integral to the seaworthiness of the ships. The non-resident person is in the business of any of the following: international transport of passengers, livestock, mail, parcels, merchandise, or goods by air or by sea. Leasing or chartering aircrafts or ships used in international transportation, or the leasing of equipment which are integral to the seaworthiness of ships, or the airworthiness of aircrafts used in international transportation. The resident person that performs any of the activities described earlier would be exempt or not to be subject to corporate tax that is of a similar character to corporate tax under the applicable legislation of the country or territory in which the non-resident person is resident. Now we can discuss of some reliefs. First of all, and we can discuss the transfer within a qualifying group. First of all, what is a qualifying group? Two or more taxable persons that meet the following conditions. The taxable persons are juridical persons that are resident persons or non-resident persons that have permanent establishment in the state. Either taxable person has a direct or indirect ownership interest of at least 75% in the other taxable person, or a third person has a direct or indirect ownership interest of at least 75% in each of the taxable persons. None is exempt person, none is a qualifying free zone person, and the financial year of each taxable person ends on the same date. Both taxable persons prepare their financial statements using the same accounting standards. No gain or loss needs to be taken into account in determining the taxable income in relation to the transfer of one or more assets, or liabilities between two taxable persons that are members of the same qualifying group. Moving next. As you are discussing about a qualifying group, transfers between the qualifying group, the transfer of the asset or liability shall be considered as undertaken at net book value. Hence, neither a gain nor a loss arises, and the value of any consideration paid or received against this transfer shall equal its net book value. 2 years from the transfer, failing to which the original transfer shall be treated as having taken place as at market value or as on the date of transfer. Another relief we can discuss is business restructuring relief. Gain or loss on transfer of business or an independent part of business of a taxable person to another taxable person in exchange for shares or other ownership interest of a person. Our final topic is, I hope you guys can see me, a small business relief. Small resident A resident person that is also a taxable person may waive to be subject to corporate tax if the revenue on the relevant and previous taxable period earned do not exceed the threshold of 375 dirhams. Also, all other conditions should be met. Small business relief is not applicable when it applies to exempt income reliefs, deduction and tax loss relief. All businesses who have elected for small business relief must comply with the conditions, as the authority may ask for relevant information and records from the taxable person within a certain timeline to verify the conditions mentioned were met. So this is from my side. I will hand over to my colleague Muhammad Wasim.
Hi everyone, this is Muhammad Wasim Khan, Assistant Manager at XP4, and today I will discuss in my session the remaining some topics. So the first is the transfer pricing between related parties and connected persons. So first I will let you know what are related parties. According to International Accounting Standard, the related party is a person or entity that is related to a reporting entity. So a person or a close member of that person's family is related to a reporting entity if that person has control, joint control, or significant influence over the entity, or is a member of its key management personnel. An entity is related to a reporting entity if, among other circumstances, it is parent, subsidiary, fellow subsidiary, or a joint venture of the reporting entity, or it is controlled, joint control, or significant influenced or managed by a person who is a related party. So now the transfer pricing deals with the transactions with the related parties, which might be a transfer of resources, services, or obligations between a reporting entity and a related party, regardless of whether a price is charged. In order to deal with In order to deal with such transactions, the authority emphasizes on the arm's length principle, which states that the transaction or arrangement must be consistent with the results that would have been realized if persons who are not related parties have engaged in a similar transactions or arrangements under similar circumstances. The arm's length results of a transaction or arrangement between related parties must be determined by transferring pricing methods, which has been published by OECD guidelines. There are 5 methods. The first is comparable uncontrolled price method. The second is resale price method. The third is cost plus method. The fourth is transitional net margin method. And the fifth one is the transitional profit split method. A taxable person may also apply and transfer pricing method other than these 5 methods, where the taxable person can demonstrate that none of the above methods can reasonably apply to determine an arm's length principle, and that any such other transfer pricing method used satisfied certain conditions. For the tax purpose, uh, it is also important to know that there are also certain factors which needs to be considered to select and apply transfer pricing methods, which includes the contractual terms of the transaction or arrangement, the characteristics of the transaction or arrangement, the economic circumstances in which the transaction or arrangement is conducted, the functions performed, assets employed, and risks assumed by the related parties entering into the transaction or arrangement, the business strategies employed by the related parties entering into the transactions or arrangement. What are the consequences if a related if the transaction or arrangement between related parties does not fall within the arm's length range? The authority shall adjust the taxable income of both parties to achieve the arm's length result that best reflects the effects and circumstances of the transaction or arrangement. And this adjustment will also impact the tax payable amount of the both parties. The documentations which required for the transfer pricing is transfer pricing disclosure form, which needs to be filed with the tax return as requested by the authority. Also, the maintenance of master file and local file and such documentation must be submitted to the federal authority within 30 days on request. There are other some requirements or informations which might be requested by the authority to support the arm's length principle, and that document should be submitted within 30 days or date directed by the authority. Our next topic is tax losses. So what is a tax loss? A tax loss occurs when total expenses are greater than total revenues under the tax reporting period. A law is quite progressive in nature that it allows taxable person to carry forward the unadjusted losses to future tax periods. In other jurisdictions, the tax losses can be carried forward up to certain tax periods, but the UAE law didn't specify the periods and it can be carried forward indefinitely until they are fully set off. However, in the UAE law, businesses can only carry forward tax losses up to the maximum of 75% of the taxable income in each subsequent period. It doesn't mean that the businesses cannot carry forward the total loss, but the 75% of taxable income is the maximum allowable loss for that specific subsequent period, and the remaining loss, if there is any, can be carried forward to the next period with the same rule. In order to carry forward such tax losses, there are certain conditions which needs to be fulfilled by the taxable person. The first is the owner or the shareholder of the taxable person under the ownership of which the taxable person made losses must hold at least 50% of the share capital in the subsequent period. Or if the change in ownership is below 50%, then the taxable person still can carry forward such losses provided that the taxable person is continued with the same similar business or business activities. There are also certain conditions where a taxable person is unable to get relief on its tax losses. For example, losses carry forward before the commencement of the corporation tax. Losses incurred a person becomes a taxable before a person becomes a taxable person, or losses incurred from an asset or activity, the income of which is exempt. Here, another relief the authority is giving, that the transfer of tax losses between the taxable persons. Let's suppose there are two group companies. Company A has made profit and the other company B has made a loss. Now the loss of company B can be adjusted against the profit of company A. In order to transfer such losses, there are certain conditions which needs to be fulfilled by the both parties. Both taxable persons uh, must be juridical persons and resident persons. Either taxable person has a direct or indirect ownership interest of at least 75% in the other, or a third person has a direct or indirect ownership interest of at least 75% in each of the taxable person. The common ownership must exist from the start of the tax period in which the tax loss is incurred to the end of the tax period in which the other taxable person offsets the tax loss transferred against its taxable income. The other is that none of the persons are exempt persons or qualifying free zone persons during the transfer. The fifth is the financial year of each of the taxable persons ends on the same date and they prepared their financial statement using the same accounting standards. Now, my next topic is the tax groups. First, let me explain what is difference between a parent company and a subsidiary company. The subsidiary is a company which is held or owned or controlled by a parent or holding company. Usually, the parent company will own more than 50% of the subsidiary company. This gives the parent organization the controlling share of the subsidiary. Now, who can form a tax group? Two or more taxable persons can elect to form a tax group and capable of being treated as a single taxable person for corporate tax purposes. But still, there are certain conditions which need to be fulfilled by the taxable persons in order to be a tax group. The first is uh, both the parent company and the subsidiary must be resident and juridical persons. The parent company owns at least 95% of the share capital of the subsidiary. The parent company holds at least 95% of the voting rights in the subsidiary. The parent is entitled to at least 95% of the subsidiary's profit and net assets, and the both all the members in the same group have the same financial year and the same accounting standard has been followed by all the members in a group. But there is the authority is also emphasizing that a tax group cannot include an exempt person or qualifying free zone person, from which they can benefiting the 0% corporate tax from their taxable income. The parent company must submit an application to authority in order to form a tax group. Here is a question that can a foreign entity be a part of a tax group? Yes, the foreign entity which is effectively managed and controlled in the UAE is considered as a UAE resident entity for the UAE corporation tax purposes, and hence it can be included in the tax group. The next is what is the formation and cessation date of a tax group. A tax group shall be formed or a new subsidiary shall join an existing tax group from the beginning of the tax period specified in the application submitted to the authority or the beginning of any other tax period determined by the authority. The cessation date is the relevant member of the tax group shall be treated as leaving that tax group from the beginning of the tax period specified in the application submitted to the authority or from the beginning of the other tax period determined by the authority. There is also another condition where the concerned member of a tax group shall be treated as having left that tax group from the beginning of the tax period in which the stipulated conditions which have been mentioned above no longer meet. Now, the next topic is what is the taxable income of a tax group. For the purpose of determining the taxable income of a tax group, the parent company shall consolidate the financial statements, results, assets, liabilities of each subsidiary for a relevant tax period, eliminating the transactions between the parent company and each subsidiary that is member of the tax group. There are certain adjustments which needs to be made when making the financial statement of consolidated financial statements. The first is that unutilized tax losses of a new subsidiary that have joined the tax group can offset the taxable income of the tax group relevant to that new joint subsidiary. The second is the unutilized taxable losses of the existing tax group cannot be used to offset the taxable income of the newly joined subsidiary. Where a subsidiary leaves a tax group, tax losses of the tax group shall remain with the tax group, with the exception of any unutilized pre-grouping tax losses of the relevant subsidiary. So there is a question that what will happen to be utilized tax losses on the cessation of the tax group. So there are two cases. First is where when a parent company continues to be a taxable person. In this case, all tax losses shall remain with the parent company. The other case is that if a parent company ceases to be a taxable person. In this case, tax losses shall not be deductible for individual subsidiaries, with the exception of any unutilized pre-grouping tax losses for such subsidiaries. The next topic is what is withholding tax and what is the credit. A tax deducted at source, especially one levied by some countries on interest or dividends paid to a person resident outside that country. The withholding tax present at 0% is applicable to UAE sourced income of non-resident persons and other specified income. It shall be deducted from the gross amount of the payment and remitted to the authority. Payments made by the UAE business to a non-resident earning UAE sourced income will subject to holding at 0% rate unless the income is attributable to a branch or a permanent establishment located in the UAE. The law further states that any other rate may apply as will be specified in a decision to be issued by the cabinet. The maximum withholding tax credit that can be adjusted is the lower of withholding tax payable or the corporate tax due. Here is the foreign tax credit. What is a foreign tax credit? Foreign tax credit is a tax credit available for any foreign taxes paid on a UAE taxable person's income. The foreign tax cannot exceed the amount of corporate tax due on the relevant income. Any unused foreign tax credit cannot be carried forward or refunded. A taxable person shall maintain all necessary records for the purpose of claiming a tax credit. Now here we will discuss the refund of corporate tax. A taxable person can submit refund request to the FTA to claim corporate tax refund in the following cases. The withholding tax available exceeds the taxable person corporate tax payable, and the taxable person has paid corporate tax in excess. Like the VAT law, the FTA issues a response on the credit which we apply for the refund. The same in the corporate income tax, the taxable authority will notify the taxable person regarding the refund, is it approved or not. Here is the main topic, which is a anti-abuse rule. So what is general anti-abuse rule? GAR empower the tax authority to deny tax benefit of transactions or arrangements which do not have any commercial substance and the only purpose of such transactions is achieving the tax benefit. There are certain tax advantages which the taxable person may take while using such transactions. The one is refund or increased refund of corporate tax, avoidance or reduction of corporate tax payable, deferring a payment or advancing a refund of corporate tax, avoidance of an obligation to deduct or amount for a corporate tax. Where it is applied to a transaction or arrangement, the Federal Tax Authority may take a determination to counteract or adjust the corporate tax advantages obtained as a result of transactions or arrangements. Now we will discuss about the transitional rules. Transitional rules provide guidance for transitioning from the existing legal system to the new legal framework. The transitional rules set here enlist the provisions that are required to be implemented to the transition smoothly from the pre-UAE corporate tax law system to post-UAE corporate tax law regime. So the transition rule is a taxable person opening balance sheet for the corporate tax purpose shall be the closing balance sheet prepared under the accounting standards applied in the UAE, which means that before the commencement of the corporate income tax, the taxable person should have financial statements, audited financial statements before entering into the corporate income tax regime. The accounting standards that are to be followed refer to the standards that are applicable in the UAE on the last day of the financial year. And the authority also states that the opening balance sheet shall take into consideration the arm's length principle, which we have discussed in our prior slides. Now, the main topic here is the violations and penalties. Assessment of corporate tax refers to the reviewing and evaluation of information filed in the tax return by the taxable person. It is done to ensure that the information filed is correct and there is no foul play by the taxpayer to evade payment of tax liability due. Furthermore, the law also provides for penalties in cases of violations or non-compliance of corporate tax procedures by the taxable person under the UAE corporate tax law. But the law didn't prescribe that how much the fine will be implemented and how it would be calculated. But it would be similar to the VAT penalties and fines which is imposed by the FTA. This was from my side. Now I will hand over to Mr. Yasir.
Thank you, Wasim, for your presentation. I want to thank all the presenters, Mohammed Fauzi and Zohaib, as well as I want to thank you all for your attendance today. I'm sorry we ran out of time, almost 21 minutes after the hour. So we will take any questions separately on, individually. We'll address any questions we receive. But I hope to see you again on future sessions, and thank you again, and wish you a happy, good day. Thank you.